Hello, everyone, and welcome to ICM's Week Ahead. So first, as usual, we're going to start talking about what happened during the last week and just go over some of the key movers and then highlight the top economic events to come this week. You have a lot of economic indicators also to be released, and then go over the MetaTrader 4 platform to just check some of the setups, and there are numerous of setups being constructed. So starting with COVID-19, we're just monitoring definitely the vaccination, which is going pretty well around the world, especially in the United States, United Kingdom, and this is just another optimistic factor for the market to restore some positive risk sentiment. Also, we can see some of the numbers going back to pre-New Year level, which is also a bit optimistic for the general economic activity. So now we're just start expecting a little bit of an easing to the restrictions around the world, and this could just boost the economic activity and just take the economy into proper recovery form. The second of the major event that took place last week, and everyone was watching it, was the Federal Reserve Chairman Jerome Powell's semi-annual testimony, where he testified about the monetary policy. So according to Powell, the current monetary policy is appropriate. He reiterated that there should be a lot more done in regard to create again more jobs, to have a better labor market, and he believes that the current unemployment rate, the real unemployment rate, is much higher or way higher than the unemployment rate that comes out every beginning of the month, and this definitely goes back to a calculation for the labor market and other calculations for the labor market. So this is what was Powell hinting on, that there is more to be done. He was just trying to ignore a little bit what's happening with inflation and just mention that it's normal to expect a rise in yields, and we're going to talk about yields in a while, if we expect the economy to recover properly. And he believes that the Federal Reserve has enough tools to tackle inflation in case it went well over the targets. However, currently the Federal Reserve is just focusing on restoring economic activity properly, restoring a proper growth pattern, improving the labor market, dropping unemployment rate to its targets, while also being able to deal with unemployment rate with the inflation rate if it shot higher above the Federal Reserve target. So this was just a little bit disappointing to those who were expecting a little bit of comments on what's happening in bond yields. So what we were seeing in the yields in the past couple of 2-3 months, so the rally that started a while ago in treasury yields is just so significant, and recently it just it sharpened or it straightened. So we saw a huge rally in yields, especially following Powell's testimony. So on Thursday mainly. So what's happening usually when we start expecting an economic recovery to take place, also we start expecting inflation to go back slightly to normal levels. So those who want to buy the bonds will start asking for more compensation to just adjust for inflation. This will definitely lead the rates higher, the yields higher. So this is what's happening mainly. So investors are just asking for more compensation as the economy goes back on track, and this is what is just pushing bond yields higher. We saw the 10-year yields rising to their highest levels since February late year, so almost in a year ahead of the crash that took place on the pandemic. And this just also signaled that the Federal Reserve will have to deal with the rising yields, since, as we know, when a government wants money, they just go for borrowing money, and if treasury yields, they're just rising again, or the yields around the world, bond yields are rising. So this means that the borrowing costs for governments, they're also on the rise. So this will create a lot of problems later on. So this is why also we're seeing some very cautious or attentive profile from the European Central Bank officials. They highlighted last week that they're following carefully the rise in yields, because we remember what happened back then with Spain, Italy, Portugal, Greece. So when yields go up, bonds go down, and this is just not very appropriate to these European countries. So that's why we have to keep an eye on what's going to happen with yields. whether central banks would jump in to cap any rise in yields. We started seeing the first joiner was the Reserve Bank of Australia, which announced that they're doubling the asset purchases ahead of the meeting, in a way just to cap the rising yields. So this is just the first bank to jump in after the current rally. Now we have to just grasp some attention on how the Federal Reserve will act with the current rising yields. Solid economic data suggesting better recovery. So as I said, since Powell just linked all the normalization of monetary policy to mainly improvement in labor market and growth, disregarding slight inflation. So all indicators that signal a better improvement or a better situation in the labor market would just definitely be better for the dollar. Since we saw on Thursday unemployment claims that they were well below expectations, so this is just a good sign that the economy could be, the labor market could be coming some track. And this also raised expectations for the jobs report for February, which we're expecting on Friday. So we have to keep watching these economic indicators as they come out, since they will definitely weigh on the expectations of going back to normal monetary policy by central banks around the world. So if we see a huge recovery, a fast recovery, a jump in employment rates, so this could just add the chances of tapering, mainly tapering the asset purchases program sooner than expected. So these are the key factors that are affecting the market mainly. So bond yields, economic indicators, Powell's testimony that took place last week, and all the news on COVID. There's a slight reminder that also the CDC approved Johnson & Johnson single-shot coronavirus vaccine for widespread use. So this is also positive news for the market. Also, the House of Representatives passed Biden's $1.9 trillion stimulus plan. Now the Senate will have to vote on this. Maybe it will take like almost 2 weeks to just discuss in the Senate and then approve it. So this is also what's supporting the market earlier today and just weighing a little bit on the dollar. So let's start with let's move forward with the economic indicators that we are expecting this week, or economic events. Starting with it's more early from Australia, the Reserve Bank of Australia interest rate decision. No changes expected, just a little bit off consultation on the recent rise in or add in asset purchases. Moving to Eurozone from Germany, you have unemployment change expected to show a drop towards -13 from -41. This is just an improvement on unemployment change. Also from the Eurozone, the consumer price index year-on-year expected to rise 0.9%. This is just a huge improvement from previous, and this is mainly led by what we're seeing, mainly with the economic recovery, or bets on economic activity coming back to track. So this is just also improving. You can just, a small reminder that you can separate the rise in consumer price index from the rise in price of food and oil by just using the core CPI instead of using the CPI to assess the economy, the inflation. Moving to Canada, the GDP month-on-month also is expected to show growth in December by 0.3% versus 0.7% in November. And then we have the weekly crude oil stock by the American Petroleum Institute from the United States. On Wednesday, also we start from Australia with the GDP, the second reading of the fourth quarter GDP of Australia, showing expected to show a growth by 2.5% during the fourth quarter. A solid reading from Australia. Moving to the Eurozone, we have the services PMI, final reading for services PMI for February expected to drop slightly from January reading to 44.7. On the United Kingdom to remain on hold, 49.7. Also, we have the OPEC Plus meeting on Tuesday and Wednesday to discuss the recent market supply. So this is just an important event for oil traders. Moving again to the United States, where the ADP non-farm employment change expected to show a job creation of 172,000. Services PMI from the United States to show an increase to 58.9 from 58.3. The ISM non-manufacturing PMI, an important reading, expected to remain at 58.7, which is very good reading. and then the crude oil inventories by U.S. Energy Information Administration to continue to see a decline in inventories by 5.190 million barrels. On Thursday, we start also again from Australia with the retail sales, which are expected to show an increase by 0.6% in January. Construction PMI out of the United Kingdom to rise above the 50 threshold to 51.0. This is just an optimistic reading. OPEC meeting, and then the retail sales from the Eurozone expected to show a contraction by 1.1% in January, and unemployment rate to remain on hold at 8.3%, while initial jobs claims to rise slightly to 750 from 730,000, and factory orders in the United States to rise by 2.1%, which is also an encouraging reading. On Friday, it's one of the most important days due to the non-farm jobs or the non-farm payrolls and the jobs report. So we start first with the German factory orders, which are expected to show an expansion of 0.7% in January. Moving to the United States, the jobs report is expected to show average hourly earnings rising by 0.2% in February, month on month. Normal payrolls show job creation of 180,000. Any reading above 200, 250,000, even maybe 300, a positive surprise. This could just support a little bit risk sentiment, but also support the dollar, since it would lead to further chances of faster normalization. Also from the United States, unemployment rate to remain on hold at 6.3%. We have to also focus on the participation rate. So any drop in unemployment rate due to a drop in participation rate, this is not a solid reading. While if unemployment rate drops with participation rate going up, this is just a very good reading, and definitely the market will cheer up such reading. And then we end the week with the S. Baker Hughes oil rig count. Just a small talk about the OPEC Plus meeting expectation. So as we know, Saudi Arabia just voluntarily agreed on cuts for 1 million barrel per day for February and March, and this supported the markets significantly. We saw prices rising more than 20% since this decision. So now what the market is expecting is just a continuation of an addition of supply by almost 500,000 barrels, the usual that was expected previously. But what we have to focus on is how Saudi Arabia will just go back from these voluntary cuts, whether Saudi Arabia is just gonna go back to pumping additional 1 million barrel of oil every day in the market, or this will happen gradually. So this is just an important figure to watch out for the market. On the other hand, OPEC Plus will discuss the resurgence of US shale oil, especially as prices rose above 60, and this is just so encouraging for shale oil producers. So this is definitely will put some pressure later on OPEC Plus producers, and this is what they have this is why they have to just be cautious with what's happening in the market. Now let's move to the MetaTrader 4 to just discuss some of the formed patterns. We have plenty of patterns. First, let's start with the euro dollar. This is the 21. We're using the 21 exponential moving average. So on the weekly chart, you can see how we're just receding near this moving average. We go to the daily chart, you can see how the market reversed today sharply. We had this inverted head and shoulder formation. However, we had a failure. So this was the neckline, closed neckline. The market went to the upside and then reversed the second day, and now we're just moving lower again, erasing the retracement that we had earlier. So what we have to focus on is just any dip back below today's low, which was previously also another important low near 2020. A dip below 12020 could just drive prices a lot lower. So the first support zone that could come in is 1940, while any drop below there could just trigger further downside. Well, in order to just turn bullish again on the euro, we need to move back above 121.80. I'm just going to draw the channel that we've been highlighting for a while for the euro dollar. This was the channel that we were highlighting for a while for the euro dollar, and the market just got closer to it a while ago. So watch out for the bottom, a retest for this bottom of the channel, which is coinciding with the previous support zone. So this is all for the euro dollar. Moving to the British pound against the United States dollar, which had a pretty good rally last week, but like had a clear reversal from the top that we've been highlighting. If you were watching this the week ahead, previously, you can remember that we were talking about this channel, and you can see how the market topped exactly at the top of the channel. So we have this channel, the market rallied to the top of the channel and then reversed exactly. And you can see how the 21-day exponential moving average was acting as a key support for a while. Any dip below the 21-day was being bought, and the market moved above it. So watch out now for any possible drop below this key area. My key area remains to be 37.57. Any break below 37.57 could just be more bearish for the British pound against the United States dollar. Among the key factors why the British pound is rallying this much is that the United Kingdom is just ahead of peers in the vaccination program, and this is just adding to the prospects of the economic activity coming back to normal in much less time. So this is one of the reasons. Another reason is just the surge in inflation in the United Kingdom, which could cause the Bank of England to completely avoid going into negative interest rates. So these are all coming into favor of the British pound. So this is just a key area. It remains a key area for the British pound against the United States dollar, 37.57. A minor support, an interim support, 38.84. So it's one of the interim support. Moving back above 140.50 is just key in order to resume this uptrend that was taking place, targeting 142.27 again. So these are the key levels if you are trading the British pound against the United States dollar. Moving to, also you can just, before moving to another pair, you can just draw this trend line combining these bottoms, or just go for the recent bottoms by just going for this one, which was also at the time a proper channel by combining these also tops here. So we had a little bit of a spill up this channel. So watch out for a dip here towards 38.10. The US dollar against the Swiss franc. So this was just from last week. We were highlighting, first we had this the trend line and how the market was able to break above the trend line and then continue to the upside. We had a reversal slightly here, but key levels remain 0.9190, 0.92 is a key level. Previously, back in August, September, October, we had a range trading for a while between 0.9 and 0.92. We could be entering this range again, especially as we had the first reversal from 90.50. The market went lower and then moved to the uptrend again. You can just draw also this channel by drawing these bottoms here, just focusing on this, and now we're moving above this channel. So watch out for any moving back in it. You can just use it again. However, currently we're just stepping out of this channel. The coming level could be 0.92 and then 0.9295, 0.93, and a reversal back 0.9050, 0.9 could just turn bearish again, and we could be heading lower towards 0.8870. We skipped the dollar against the yen. So this was also drawn, this is previously, just gonna repeat these. Okay, so we have this trend line. I'm just gonna redraw this. At the trend line, a clear breakup of the trend line, a correction, and then the market move to the upside. What could be coming next for the dollar against the Japanese yen? You can just draw this channel, and you can see how the market is working perfectly well with this channel. 1, 2, 3, 4, 5, 6, 7, 8, and now we're at the top of the channel again. You can see how systemic is this move, and we're getting closer to previous key levels. 107 was one of the key levels previously before all this took place through the whole move. It held for a while, so this is just a coming possible resistance ahead of 108.15, 108.20. These are possible good resistance zones. While if we move back below 105.70, this could just turn bearish again for the dollar yen, and we could be targeting again 104.40. So these are the key levels. Watch out for these key levels. Watch out for how the pair could just move with this channel. The Australian dollar against the United States dollar, also a perfect move to the upside. We were just highlighting for a while this trend line that the market is currently sitting at. Also, you can just see how the market exactly reversed from the top, where we could have the stop by just combining these previous two tops, 1, 2. You can see how the market exactly reversed from here. We had I guess we have a possible from between these two tops On the RSI, it's very clear here. If you just go to your other RSI, you can see how the RSI here, it's lower, it's higher. The price is higher on the second top, while the RSI is lower. Pretty clear divergence for the Australian dollar against the United States dollar on the daily time frame. So watch out for any break below this trend line. A move or a dip back to 75.60 is just scary. It could be scary, a little bit scary for the bulls. These are the possible targets. So 75.60 and 74.15. These are very two crucial, important targets for the Australian dollar. Important support levels. Watch out for any break. While in order to turn bullish again and just target another move back above 80 level, we need definitely to clear back above 0.7820. This is just becoming a pivot point for the current trend. The New Zealand dollar against the United States dollar, almost similar formation. So you can see a higher high for the New Zealand dollar, and the pair failed to hold these gains and moved lower. Again, what you can do is just to draw a trend line combining these bottoms here. Watch out for any dip below this trend line. In order to turn bullish, we need to definitely move back above 73.10, else we could be just poised towards further downside, where the first support could come in at 70.90, 71 level, and the second at the 70 psychological level. The US dollar against the Canadian dollar, we were talking for a while about this formation that was taking place, the trend line that is still currently holding, and this bottom trend line here that's combining these bottoms. So you can see how we're stuck inside this range, and the market reacted, dropped directly from this this trend line. So you need to watch how this will come and play. A break above this trend line can just drive us higher towards 128.80 and even higher up to almost 130 levels. So this is the possible area that we could be targeting on a break above this falling trend line. While moving back below 25.60 is just bearish again for the pair, and we could be going towards further lows. Gold is falling sharply after today's recovery. So if we go to the weekly chart, you can see how the market is just falling sharply, especially last week following the rise. We had a good pullback. If we go to, if we draw this trend line here, you can see how the market exactly worked technically and moved from in a technical manner and moved exactly lower from this trend line. What you can do for gold prices, you can just draw this channel here, combining these tops and bottoms, and just watch out for a possible dip towards the 1700 level. You can just also support this by a trend line combining these previous bottoms. So this means that this area is very crucial, very important for on a technical pattern. So watch out for what could come and play. If US yields continue to move higher without any cap, this could just add to gold's losses. If we see any possible intervention from the Federal Reserve, this could just trigger an upside rally in gold prices. So you can see how this point here is just very important, very crucial. This area here, by combining these previous trend lines, the channels, you can see how important this area is here. So I'm just going to highlight some of the key levels. 1760, which is the area that we rebounded exactly. You can see it was a clear support 1-2 times, and previously it was a key area. And then the market rebounded exactly after rallying towards 1759. You can see on the hourly chart how the market was reversing since the open today after last week's sharp decline. However, when it reached exactly 1760, which was previously a key support, the market reversed clearly. So now we need to turn again towards 17700, 1717, and 1700 as possible supports. An extended target to the downside could be just almost near 1680, while we need definitely to move back above 1760 in order to tackle further upside towards maybe even 1815. However, as long as we're below 1760, failing to clear above 1760, this is just hard for the prices to rally again. This is just a trend line where a violation of this trend line could just mean that the market could be ready for a possible reversal. You have to watch out also this trend line. Moving to silver, which is holding slightly a little bit more than gold. You can just draw a trend line combining these three bottoms here and watch out. This is a possible support, a key support, which is coming near almost $26. It held 3 times any break below the support could just drive prices lower. Also, you can just combine these previous bottoms. You can see how the market's moving in trend line 1, 2, and 3. A break below 26 could just drive us lower towards 24.80, while we need definitely to move back above 28.30 to turn bullish again. Else we could be poised to retest to this lower part of the range. Moving to WTI. So if we just we're having a slight problem here. We just combine bottoms and the tops of the recent rally. You can see also how the market is moving exactly in this channel to the upside, a clear upside uptrend with higher highs and higher lows. Until now, we're just holding. OPEC, definitely OPEC meeting is in focus. Watch out to any break below $60. It could just trigger a bigger correction, and we could be stuck in a range between $53 or $54 per barrel to 64 watts. So any reversal from here could just lead to a possible sideways move. Watch out for the 21-day exponential moving average, which for a while was a good buy at the dip for traders. So watch out how the price will react when it gets closer to the 21-day exponential moving average. A break above the current high could just lead to another rally to a key area here. You can see how this area is very clear here. We highlighted it last time by combining these previous tops, and the market exactly rallied to, I'm just going to delete these so it's clearer for you. You can see how the market exactly rallied to the price by combining that we can get by combining these previous two tops. So moving above this trend line could just take us higher towards, if we just go to the weekly chart, maybe we could be aiming towards these tops near $72 a barrel on the long run for oil. Else here we could just be going for another correction. You can just highlight these possible levels here for a possible rebound, another buy towards a push higher towards $73, $74 per barrel. Moving to the Dow Jones, which is holding well after last week's decline. So you can see how the market rose exactly to above a new high, and then the market moved lower again. We were highlighting this channel for a while, and you can see how the market exactly rose to the top of this channel and reversed from the top of this channel. So what you can do is just highlight also this movement. So you can see the market failed to stay more than 2 days above this channel. So watch out on a further increase in yields or further rally in yields. This could just lead to another round of selling on stocks where a possible target could be 30,060 for the Dow Jones. Else, as long as we're above the previous week bottom, above 30,850, we could just be tackling again 31,700, which was previously a key resistance ahead of spiking higher towards an all-time high. So this is the range that we could be trading in it for a while if we lack any key drivers. This is all for today's session. If you have any questions, please write them down. I'd just like to remind you that all the information, news, analysis, and opinions mentioned in this webinar, they're only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. Perfect. I believe this is it for today. Thank you all for joining, and I wish you all a successful trading week.